In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Great, everyone. How you going? It's Phil Tarrant here. I'm host of the Smart Property Investment Show. I hope you're well. I'm recording this in lockdown, and it feels as though we're going to be that way for a little while, keeping an eye on border closures and the actions, the behaviours, the attitudes of our state premiers as they embark on what is going to be a significant disruption to Australia moving forward. But guess what? We're recording this over the marvels. That is digital technology. Who would have thought when we kicked off this podcast? Now, I've changed my attitude quite a lot to this over the years, where I only really wanted to podcast in person. I felt as though you get a much better outcome as a result of it. Some of that still holds true, but power of Zoom means I can eyeball people, I can see them, I can understand what they're thinking and how they're perceiving a particular topic. So it makes podcasting pretty easy, and therein lies the opportunity with digital. As you all know, if you've been tuning in this for quite some time, I'm very pro-digital, pro-disruption. I'm an investor in digital technology myself in a number of different ways, particularly in prop tech, because it's one of those areas. And I think to real estate and the real estate sector and the ways in which things have been done in real estate for many, many years, probably the last bastion of an industry sector in Australia that really required some disruption. And that's taking place right now purely because it's had to. The nature of lockdown means that people have had to think differently about doing stuff. And what's happened, I think personally, is that it's just accelerated the change that needed to take place in real estate. And that obviously translates into mortgages. Now, everyone's been talking about digital mortgages for many, many years. It's not a new idea. A number of the major banks have tried to do a digital play, some to good success, some to other success. But now the technology is really behind it. So the realization of a purely digital mortgage is a lot closer than what it has been beforehand. So we're going to chat about this on the Smart Property Investment Show. I'm all about customer outcomes, customer behaviors. I want to make sure that property investors, irrespective of where they are and what they're buying and how they're buying, have access to the best finance possible. Joining me in the studio today, we're going to get into digital mortgages and all things digital mortgages, get a stock take on where we are right now and what the future looks like, but also how it all works and whether or not it's right for property investors. CEO Andrew Walker of Nano Home Loans. How you going, Andrew? You well?
Very well, Phil. Thanks for having me. I appreciate the opportunity to talk to someone other than the cat.
It gets that way, and quite a long-winded sort of introduction into how COVID-19 has been an enabler, I think, for changing and shaping mindsets and attitudes, and also changing regulators and their ideas and perceptions towards the way business should be done, particularly in financial services and in mortgages. Probably one of the best things that ever happened to your business was COVID-19 to help drive and shape that change and get people to embrace digital as natives. Yes, yeah. No, indifferent?
Yeah, you were dead right in your introduction. Look, COVID depends on which research paper you read or who you listen to, but anywhere from 5 to 10 years of digital acceleration has happened on the back of COVID. And that's a global trend. It's happened here. And what we're seeing, if you look at the research reports, is people are moving up the complexity curve, Phil. So everyone's familiar with the Amazon one-click. That's sort of small purchases that happen frequently. And everyone's familiar with buying and selling cars online, ordering movies. And the real question that people have started to ask themselves more and more over the last 18 months is, well, if I can refinance or buy consumer products online instantaneously, then why can't I do that for a mortgage? A mortgage it's a pretty simple financial product. It's just bigger than most of the others. And the answer is there is no reason you shouldn't be able to do that. And that's the disruption.
Yeah, I remember it was interesting. I spent some time out in San Francisco probably 4 years ago with some very bright people within the mortgage sector out there. And you'd be across all of this, but also some of the big tech companies out there and the, what do you call them, the evangelist type people talking about disruption in mortgages. And it was funny, the intersection between their views of digital connectivity and then also the role of the human. And it's a real sort of, irrespective of your age, millennials, Gen Xers, Ys, or whatever they are, there's still this perception that it is a big decision and they still like some human interaction. Can you give us some sense to how this sort of symbiotic relationship will take place moving forward with digital mortgages?
Yeah, it's a really interesting comment. It's increasingly moving in the opposite direction is probably the first point that I'd make. If we take a step back, so why do people feel like they need that human interaction? And a lot of people do, and I think that's fine, and we'll continue. One of the main drivers is not because they want it, it's just because that's all that there is available. So the human interaction, the mortgage process, if you think about a lot of the industry, it's the paper mache over a broken process. So the reason that you've got people involved is because they're helping to explain the opacity of the industry, the complexity of the jargon, and make the process a little bit better than the broken thing that it is in the background. Now, as digital mortgages have their heyday and they grow rapidly, we can talk about that in a second, you'll find that people will actually say, well, I actually need someone to hold my hand because the process is so easy and simple. And that's the core of our business. So will digital mortgages, digital journeys completely replace human beings in the process over time? I doubt it. In fact, I'm 100% sure that won't be the case. But it certainly will lead into it.
Yeah, and this is digital being an enabler. Speak about real estate, and this is, here's a question for you. What business are you in? Are you a fintech? Are you in mortgages? Are you in real estate? If I met you at a barbecue and say, g'day, I'm Phil, I do podcasts, what would you say? I'm Andrew Walker, I do...
So we're a technology company first and foremost. Some people would put us in the fintech category. Some people would put us in prop tech, but we're technology first. And we use digital data and design to disrupt processes that need disrupting. So the reason we're in business today and our first product to market is a digital home loan. And the reason we did that is because we looked at the industry and went, why does it have to be so unfair, so slow? And if you look at the Australian market in particular, Phil, the largest profit pool in the Australian banking sector is the residential mortgage market. And the ROE, or return on equity, that banks get on their mortgage book is over 40%. So it's very attractive. So globally leading. So they make the most profit globally out of their mortgage book. But interestingly, it's the largest profit pool. It's the most profitable, and it's got the least amount of innovation in it. So you put those three together and say, as a disruptor, it's like picking up watermelons. The fruit is so low hanging.
Yeah, no, I completely agree with you. And it's funny, I've been in mortgages doing what I do across sort of property and mortgages and media and stuff for many years. And people think mortgages is super boring. They go, mortgages. Now, let's be fair, no one wants a mortgage, but everyone would rather buy their house in cash and own it completely. However, mortgages is an enabler for people to get into the homes and build lifestyles and families and all this sort of stuff. And a lot of people think it's boring, but what you just spelt out there, I think, is a really good case in point about how attractive mortgages is. It's most Australians, if they have a retail or an industry fund, have probably got a lot of it tied up in bank stocks. The reason why is because mortgages are so profitable. And if you think back 20 years to the emergence of brokers like Aussie or non-bank lenders at that point in time, Aussie and Wizard. The reason why they were so successful is they just shaved a little bit off the profitability that banks were making to get Australians a better deal. So what we're seeing now, 2 decades on, is a new way in which I believe through digital mortgages, Australian investors in particular, can get a better deal by doing things differently and having a chip away at the major banks. We'll have a chat about the major banks in a moment, about some of the potentially unfair tactics they're using to prioritise their retail channel over the mortgage channel. But getting down to digital mortgages and at the top end of this podcast and how COVID has helped shape and change that. Why has it taken COVID-19 for regulators to change the perception? Why has it taken COVID-19 for the base underlying business process for mortgages to happen, i.e. you don't need to eyeball anyone anymore in order to get a signature on a contract in order to give them a home loan? Why has it taken that?
Look, because it was necessary is the short answer. I mean, I can give you a long, complicated answer, but it's just because it was necessary. And then if you think about, there's a market structure point here as well, Phil, and that is in a tightly controlled oligopoly, the incentive for innovation is low. Because if 80% of the business comes to you just by virtue of the market structure, why would you bother changing something? The answer is you wouldn't. And if you've got an oligopoly that is very good for driving stability, which it is, it's not good for innovation, but it's good for stability. And then you've got the broker channel, and the broker channel are writing onto the books predominantly of those mainstream banks, interestingly, neither of those strong market participants have got an enormous incentive to change the market structure, do they? So 60 to 70% of the business coming through the broker channels going to the main four banks, who are getting 80% roughly of the flow. That represents the lion's share of the market. If you are either one of those participants, do you really want to disrupt it that much? No, you don't. So COVID-19 has come along and it's tipped the market upside down and shaken it about. And that's what's happened. You've seen regulators change their views and the market will now fundamentally shift.
Yeah, and this is, I guess, the dichotomy of the strengths of Australia's banking system translates into economic prosperity and wealth and all this sort of stuff, which is a good thing. You only need to think back to the GFC and the strength of our banks being able to help us navigate through it. But to your point, it stifles innovation because they're very happy with the status quo as it is right now. So when you see a business like yours emerge, digital home loans, are you on the bank's radar? They're obviously a bit jittery about this at the moment. They're making acquisitions of digital type lenders. You come out of a major bank. What's their perception of or towards you?
I won't flatter myself by saying they're worried. If I've got a market cap of $100 billion, I don't really worry about a digital home loan company or a technology company particularly. But that's what they thought of Afterpay 5 years ago, right?
Yeah. And you saw what happened yesterday with that.
And we saw what happened yesterday. So we certainly are on their horizons. Look, one thing that is happening now, and here's the math to think through. The Australian marketplace is about a $2 trillion stock marketplace in mortgages. Yep. And it churns at about 350 to 360 billion a year. And if you take what's going on in the US right now, where just north of 30% of mortgages in the US are written digitally. If you look at the Australian marketplace, and we're playing a little bit of catch up here, Phil, if 30% of that flow, 360 billion, becomes digital, just like following global trends, and the US would dictate that it does over the next 5 years, that suggests that there's going to be $100 billion of flow running through digital mortgage products in 5 years' time. And that's the macro wave that we are riding and leading. And there's the crushing weight of inevitability of COVID that's laid on the top of that. And so if you're sitting in, as I used to, one of the mainstream banks right now, you've got a big strategy team sitting there and pulling PowerPoint presentations together, right? And they're looking at all the research and they're worried because they're global trends. They're looking at the exacerbant of COVID and they're saying, if $100 billion of the market or a third of it approximately is going to be going through this channel, what's my answer? And here's the problem that they're facing. The problem they're facing is they're all sitting on 30-year-old plus technology stacks. They're all product-orientated shops, not customer-orientated shops. And they've got dismal track records in innovation. And so they're looking at those three factors combined with the inevitability of this market shift. And if they're not worried, they should be.
Yeah, and I picked that up. I had a look around before coming on air of your background and your business partner's background, Chris Lumby, I believe it is. You both come out of major banks, sort of innovation. But the point you made was it's very hard for the major banks to innovate considering they're using technology, which largely needs to be thrown out the window and completely restarted. But these banks don't have the capacity or the privilege to do that. But some of the major banks have made investments in digital-based lenders and digital technology. And I would say even then, the results have been pretty underwhelming. No one's really nailed it that well. So, to see the emergence of digital lending and digital home loans coming out of very smart people in Australia, and we're very fortunate in Australia to have some very talented people who now, because of COVID-19, we're able to keep all this talent in Australia, and hopefully they can kick around here. This is the future, but I want to get some sense for that. So again, looking sort of online and some of the work you're doing right now, there's a lot of people who claim to be a digital home loan. So I want to get into, really, before we get into some of the mechanics of what you do and your products and stuff, but what is a digital home loan? Is it just a digital front end with some 50-year-old middle-aged guy sitting behind a computer doing credit checks at the back end? Or is that what you've got? Or you've actually got machines that do absolutely everything?
Yeah, look, it's a fundamentally important point. And some of the analysts, so for example, some of the analysts that write in this industry are like Matthew Wilson at Evans and Partners. He calls it digital lipstick. And so let's unpack that because it's quite important, right? So it's not just having a digital front door, and a button that you can upload forms into some sort of data capture where the mice are pedaling in the background, right? So that's the innovation of 5 years ago. And that's, amusingly, when you think about it, that's actually what the fax machine has turned into. So if your digital innovation is, I'm building a digital front door where customers can go on and enter their data and then maybe get some sort of conditional approval, and then expected to do all the heavy lifting and upload their forms themselves and bank statements and all of that sort of stuff. That's not a digital mortgage. That's not a digital innovation. It's basically the fax machine 2.0. So now that's in effect what most people have got today. And in fact, what a lot of the banks are now building, they're building a better way to do yesterday's business. So let's think about what a digital mortgage is. A digital mortgage is a process where you onboard a customer, you assess the credit, you do the ID, and you give the approval all contemporaneously. And so what our business at Nano is, Phil, is what we've done is we've massively paralleled what today is an inherently sequential process. So look, KPMG say it's not just about having an online application on your website, nor is it simply offering an e-closing. It's the automation of every step through the entire loan process. That's what KPMG define it as. And it's something worthwhile having in your mind. So if you think about how you write a mortgage, what we do is we do all of those processes. We do them in parallel. So at the end of our onboarding journey, Phil, you don't have conditional approval, right? Unless it needs to go to an underwriter, and we can talk about that in a second. But where it does go straight through, we've ID'd the person, we've done the property valuation, we've done the credit assessment, we've done the responsible lending checks, we've classified the income and expenses, we've looked for the strings of data, we've put that through a credit assessment engine, and look, the fastest that we've approved a loan through our system has been sub 10 minutes, so 9 minutes and 41 seconds, and that's to unconditional approval from a customer hitting the site and starting the process to actually having the loan fully approved.
Pretty impressive.
Yeah, well, look, one of the things we've done a lot of research on this, that is actually it's the fastest mortgage product globally right now. And the reason it's the fastest is because we're the product owner and we've built the best process. So now, can other people do that? If they raise the money and spend the 2 years building it and doing what we've done, then most likely. But at the moment, we're pretty proud of what we've built. Yeah. So I think that your question was, what is a digital mortgage? What isn't it? And it's really the automation of those steps all the way through. Now, where credit gets complex, Phil, and it does require, we spoke about the human interaction before, and it does require one of our underwriting team to look at the loan application. The key difference here is when the system says, look, we'll come back to you because we need something in your application, when it goes to one of our credit underwriters, when they pick the file up, they don't start with a 35-page credit application with your name at the top and start working through it. What they've got is a system that said, I've looked at the income, I've looked at the valuation, I've got the ID, everything's fine. There's just this one thing that I can't figure out. And so the credit underwriters look for the exceptions, not the rules. And so they're going through. So the average time our credit underwriters are spending on a file when it actually goes through to them, it doesn't go straight through the system, is about 18 minutes because they're just picking something up and looking at, the data might not be clean or there might be something that the algorithm doesn't understand. So that's what we've built and that's the business that we're in. It's our first product to market.
Yeah, and a lot of people probably heard the term underwriter beforehand, but not too sure what it is. Maybe we can just give everyone a quick 101, Andrew, on what an underwriter does, because they're pretty important. And what you've done, you're actually using data matching, technology, information to be the virtual underwriter. But if for whatever reason there's a question mark, it goes to a human underwriter. What's an underwriter? Yeah,
look, the best thing, get rid of the fancy language, because it's really one of the things that the industry suffers from is fancy language to describe simple things. It's a credit assessor, right? So it's a person that looks at the application, the data in the application, and matches that to the parameters you've got for your funding. And that's ultimately what it is.
So does this make sense? Yes or no? Yes, it does. No worries. Let's proceed. Okay.
Absolutely. Yeah. Does it match the criteria that we're looking for from a credit perspective? That's kind of all there is to it.
And I want to talk a little bit about that and also funding. We'll just go to a quick break. Back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back, everyone. It's Phil Tarrant, I'm host of the Smart Property Investment Show. I'm with the CEO of No Home Loans, Digital Mortgages, Andrew Walker, chatting through disruption and the enabler that is the future when it comes to securing money to buy property in Australia and other things, but we're talking specifically around property. Andrew, you said that you were able to move so quickly to get a mortgage approved because essentially it's your money that you're lending. So can you give us some sense for your funding line? What's it look like? Where's it come from? And through success, obviously, you're probably banging down some doors looking for new sources of funding to lend other people's money. What's it look like, mate?
Yeah, look, so when I said it's our money, so what I said was that we're the product owner. And so that means that, look, we've got wholesale lines of credit and we use that money to write the loans. So we draw out of a warehouse, it goes into our trust structure and we fund the loans through that facility or those facilities. Because we're the product owner, meaning that we're ultimately taking the credit risk on it, that means that once we've got the parameter set of the loans we want to write, we can very quickly assess, we spoke about underwriting before, we can quickly assess a loan, and if it matches the credit criteria that we want to write, then we can approve that loan. Now, that's different to, for example, some other businesses out there who are taking applications and then matching the loan application to multiple different vendors in the background. So the difference there is it takes them time because they've got to get to the end of the process, do a credit assessment, bundle that data up, and then go and match that to multiple different products in the back end. And the time delay is the fact that they can't get an instant decision because they've actually got an extra step. That's I guess, the difference in the two processes in the industry today.
And we're sort of, I guess, in inverted commas, dumbing down that process. It is quite complicated and there is a huge industry that sits behind it. How are you finding just on securing wholesale funds, the attitude of those people that have these pools of cash towards digital mortgages? It must be a positive one. They can probably see, what the future looks like and some of the rigor around this by digitizing a lot of this. You do in some ways remove some of the risk.
Yeah, look, let me give you a story to illustrate that point because you're right on the nail. So with one of our wholesale lines, we had the head of credit for this particular organisation, this bank, came in and did obviously pretty deep due diligence on our process. And his exact words were, "You guys have defined what good credit assessment should look like today. This is the gold standard." And the reason that he said that was because we use source data. So we ask our customers to give us one time, which we don't get it at all. We just get access to, with them driving, their bank statements. We upload just the raw data and the algorithm assesses it. So we get 12 months worth of raw income and expense data from the banks, great. And then we classify that into the responsible lending categories. We separate the income and expenses out. We dedupe expenses where there are transfers between bank accounts. So we get a very accurate and granular view of someone's income expenses and therefore serviceability and spreads. And his point was, it's interesting how a lot of the applications we get magically look like him. It is because someone's been sitting there filling out a paper-based form and giving 3 months worth of bank statements, and the last 3 months they've been on their best behaviour and managed their affairs. And he said, everything looks pretty good when we get applications in, but with you guys, you get 12 months worth of data. You get the raw data. There's nowhere to hide. And so they do see the power of that sort of credit coming through.
Yeah, and I can see the upside benefit of that. One of the challenges, though, for property investors and people buying property, to moving forward, you've got to make sure that you've got as clean as possible or as tight as possible history on your internet banking and how you go about spending money. Erase the history if you've been maybe overspending or running outside of your comfort base in that. So that is the future. So it's a tip for me to be right across
so
that.
Look, I jump on that point because it's a macro point, which I think is actually really critical for everyone to understand, which is the data exists and the data doesn't go away. And we are moving into this era where people thinking that I can move my financial affairs from one place to another place, unless you're using some sort of Bitcoin. That's a whole different podcast. But unless you've got some fancy way of gaming the system or moving your affairs around, the data exists. It will always exist. And so if people haven't got their affairs cleaned up now would be a really good time to think, was I pushing the margin a little bit there? Now would be a really good time to think about, doing things differently, because we're entering a whole new world, right?
Oh, we are. And if you're only thinking about investing in property now, I'd be thinking 2 years ahead. As you start now, start getting good diligence and you know what? It's good for you as well, right? It's not about gaming the system. It's because it's good to do. But, and just in terms of your wholesale funds, and it's a bit technical, but often a lot of our listeners sort of want to go a little bit deeper on this. Is just Aussie gateways for you, or you got international money sort of making themselves available for lending in Australia? No doubt that's a pretty attractive proposition. Yeah. That said, a lot of international people don't understand the Australian property market. They go, it's just so overpriced. Yeah,
so our wholesale lines at the moment are Australian based. If you ask me that question again in 3 months' time, I think I'd be giving you a different answer. So we'll have some international lines shortly.
Okay, no, it's good to hear. So that just means greater diversity and no doubt your product development. But as it sits right now, you only have two products, right? You have a owner-occupied product and a investor product, and it's just one set interest rate. Is that correct?
So we've got principal and interest only.
Okay.
So owner-occupier principal and interest is at $199 and $229 for investor. And then interest only for investor is $2.59.
Okay.
So think about we've got in effect, four products.
Four products, yeah. You got two for owner-occupiers and two for investors. Interest only and P&I. And pretty much everyone listening to this will probably sort of understand how mortgages work. They're pretty sharp rates.
Yep. Look, they're sharp rates because we're a digital business, Bill. Our OPEX is low, right? We don't have $1 billion headquarters sitting down, with water views and 36 floors, which are now empty. We've got fundamentally different unit economics than the mainstream banks. So, for example, one stat which is pretty well known and you can read it in all the analyst reports, the internal cost for one of the main four banks to originate a mortgage is about $3,000. So that's their variable cost of originating a mortgage. That's just people pushing paper around and running their process. Ours is a fraction of that. And that's a function of both process inefficiency on their side and also time. So when it takes you 4 to 6 weeks to approve a loan and, 5 to 6 different people touch it on the way through, that explains that amount. When you're talking hours, minutes, not months or weeks, it changes the unit economics, and we pass that savings on to our customers.
Look, if you're able to pick up home loans like that as a property investor, that's, I've just gone through myself. I've got quite a large property portfolio dealing with about 7 different banks trying to get all my loans repriced where they haven't refinanced it. And I must admit, it was a soul destroying experience and I don't really enjoy doing it. So if you can get a good rate at the front end, that's pretty good. But I guess the question to ask on that basis is that a lot of Australian owner-occupiers and Australian investors who this is a podcast for, and you spoke about the stats, about 80% of mortgage flow goes to the major banks. There's this, you hear it before, this sort of perceived flight to quality. The government will underwrite the success of the banks irrespective of what happens, so you're safe in dealing with a bank. So what do you say to all those investors that sort of still carry, that mantle of the safety of the banks versus thinking outside of the square and looking at some of the other alternatives?
Yeah. So I think there's two answers to that, Phil. The first one is a customer service and proposition answer, and the second one is a more sort of esoteric philosophical one. Yep. So let's deal with the customer experience and rate. But if you can get a great rate and you can lock that down quickly and the process isn't arduous and the product is good, so you've got transparency, you've got no fees, you've got access to things like sub-offset accounts and full payments capability and an app to manage your financial affairs and track your investment property, good reporting out of that so you can see what's flowing in and out of that account matched against the property, then I would question, in fact, I can tell you that the experience you'll get from one of the mainstream banks will be subpar relative to that. And the reason is because they have to design their products for everyone. Right? So their internet banking, for example, captures everything from small to medium enterprise people to corporate to personal to investors. So it's designed to be a gateway. So it's very functional. It does a lot of stuff, but you have to navigate your way through 15 levels of complexity to get to the stuff you need. So if you're a property investor or our customer base being property investors and owner-occupiers, we've built the product specifically for that customer. So you get everything you need, but none of the stuff you don't. So you don't have the expenses associated with a branch network because you don't need it. You don't have to cover the costs of corporate overheads because you don't need it. You don't have big fancy executive salaries that get reflected in your interest rate because you don't need it. So I would say that the customer experience of ourselves and others like us will be better, and the rates are sharper. The second and more esoteric or philosophical point is to think through the difference between debt and equity, right? Which is and the banks love this narrative. They love it. This whole, the government will bail me out. The government's got the bank's backs. And well, if you owe someone money, right, and that company is guaranteed by the government or not guaranteed by the government, ask yourself what the difference is. Now, it's very different if you've got your life savings sitting in an institution. Yep, and that's where that government guarantee comes from and the social license that they operate with. But if you've borrowed $1 million from ABC Bank or someone else, and that organisation gets into trouble, what happens to your debt? The answer is you still owe the money. It will just get transferred from one organisation to another to manage it. That's how this whole system is set up. Now, it's very different if you've got $1 million of your hard-earned money that's sitting in an investment with a company and that company gets in trouble. Because when that happens, you're in a different position. It's your money that you can't get back as opposed to a debt which you've still got. So that's the more philosophical answer. Look, and the likes of ourselves that operate in this space, look, we've got better products, sharper rates. And look, everything's run through highly regulated trust structures, Phil. So we've got standby services, we've got trustees, we've got a bank scale quality back into our business because you have to. In order to get the sort of funding that we've got, you've actually got to operate the back end of your business like a bank. And we work in a highly regulated industry. So I think the key point there is customers should be rest assured that, when I left one of the mainstream banks to set this up, we set it up with a couple of principles. One, everything to do with money, treasury, governance, risk, compliance, everything looks like what a bank looks like because it has to in order to get the funding and to operate. Everything that touches the customer, the product, the innovation, the process, looks anything but like a bank because that's the innovation. So that's the duality of approach here, right? So back end, frankly, looks like a bank because it has to look like a bank because that's where the money comes from. Front end doesn't look like a bank because that's what customers are railing against.
Actually not a bad way to frame it. I'm sort of thinking on as a property investor going, okay, well, that all sounds good. Why should I choose you guys over the major banks? You spoke about the philosophical point of view, and I get that. A dollar a debt is still a dollar a debt. You're not putting the whole, the farm with someone. But do you get to that point now? What are your investor clients saying around going, hey, I'm happy I did that? Or what was the catalyst that made them think differently? Or what was the light bulb they saw to go, you know what? Stuff the banks.
Yep. So look, the feedback we've got, and if you look at our Trustpilot rating is 4.7, and you look at some of the feedback we've got there, people can read it online, which is the process was simple. It was transparent. There are no fees. The interest rate, as we mentioned before, at 2.29% for principal and interest for an investment loan, that's a very attractive rate for an investor. And so our customers are saying to us, look, we love no fees. We love the experience when we are a customer. Look, we've got a very innovative product structure here, Phil. So when you are a customer, you get a Visa debit card attached to the mortgage. And as an investor, a property investor, you can look at the mortgage, you can see what's sitting in your sub-offset account as opposed to the total amount that you're owing. The reporting out of it for your tax purposes is pretty sharp. It's fully transparent. You can see all of the transactions that are coming in and out through the app real time out of that account. So, for example, full payments functionality being MPP, Google Pay, Apple Pay. So if you're a property investor and you're doing some sort of property improvements, you can pay through the app. You can load the card onto your phone. Maybe you go down to a Bunnings to buy some materials to go into that property. That's tracked. It's tracked through that account. It goes through the report. You can see it instantly. It's all in one place. So fully transparent, low rates, full payments capability. And if you think about what you want as a property investor, what else do you want? You want everything in one place. You want to be able to see it. You want to interact with it. If you're making payments associated with that property, you want to be able to do that through the same platform that the property's invested through, so it's all tracked. There's no leakage. Everyone knows as property investors at the end of the year, you're thinking, what were my expenses? Oh, did I pay that out of this credit card? Did I pay it out of here? How do I bring that all together?
Absolute nightmare.
Absolute nightmare. But because we've got that payments fully embedded in the product, that's instantaneous, you can set your direct debits and credits up out of that account. So you can receive your rent directly into that account. You can, if that's what you want to do, you can make your payments on your mortgage. Obviously, you have to directly out of that account. You can do your property improvements. You can pay your bills out of that account. It's all tracked. It's all there. It's transparent. And that's what the investors love about our product.
Okay. And recording this on the first Tuesday of the month, which is when the Reserve Bank gets together and normally makes a decision around interest rates. I can't see anything happening today. I think it's going to say pretty stable, but I'm not an economist, so that's just my personal view. But how does it work with you guys? Sharp rates at the moment. One thing we do know is that rates aren't always going to be this low, and rates will go up at a point in time, whenever that is. So how will that work with your particular product?
Yeah, so we base our rate off obviously what the Reserve Bank does. So BBSW and the bank bill swap rate spreads to cash. Look, where will interest rates be in the next 3 to 4 years? Like you, Phil, I'm not an economist. It's hard to see it rocketing up right now, particularly with the second lockdown flowing through the economy. Our rates will always be sharp, and our rates will almost invariably always be under the mainstream banks because we run at a fundamentally different economic proposition, right? Our unit cost is so much lower. Our OPEX is lower, and that's where we need to be in the marketplace to compete.
So that's a structural thing for your organisation and something you can keep a hold of moving forward.
Yes, absolutely. Look, you just need to look at the fat and the largesse that sits in those mainstream lenders to see how the likes of ourselves can actually offer these sort of rates and this type of customer experience to our customer base.
Yeah. Interesting. We've got another break. We'll come back on, talk a bit of tech. Stay with us. Back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Andrew Walker, CEO of Nano Home Loans. I didn't ask you Nano. Why Nano?
Look, it represents the technology and speed of our company. So,
like a nanosecond.
Yeah, like a nanosecond. And look, we like it. It's look, as an aside, as a company that's establishing itself in the marketplace, Phil, a lot of your listeners will know this. To try to find a real word for a company right now that's less than 100 letters is nigh on impossible. And we got lucky with Nano. It's people really love it. It resonates. They get it. They understand it represents technology.
No, it works. So, look, moving into a tech CEO, tell me about sort of your last day at your bank job and then your first day. Was it one after another walking in? And no doubt it was probably in the front room of your house, your first day, sort of signing on. And what was the first thing you did?
Oh, look, I got myself a black T-shirt.
Yeah. I'm wearing, I even dressed tech today. Mandatory.
The biggest change is actually it's cultural and diary orientated, right? So as an executive in one of the big banks, my diary was booked out 6 to 9 months in advance, and my days were 9 hours long plus, and I would have maybe 30 minutes free a day. And I would go from one meeting to the next meeting to the next meeting. And almost every meeting was dealing with a problem from the past, some sort of regulation or regulatory issue that need to be dealt with, or some sort of compliance or governance meeting. There were very, very few meetings that were discussing improving the customer experience, driving the business, or moving forward. It was all, it was all process. And so for me, the single biggest difference was arriving into a new business and setting it up on day one. You sat down and went, all right, guys, how are we going to do this differently? And how are we going to change the customer experience? How are we going to make it better? And I tell you that the sense of freedom that comes from thinking about the future and thinking about disrupting an industry and thinking about it from the lens of the customer first is it's very liberating.
And you and Chris worked together at that same bank. Were you sort of professionally connected, or was you just sort of had lunch together, if you ever managed?
No, well, we did have lunch together a fair bit, to be frank. But no, we worked together. And both of us, the thing that connected us, Phil, was we both had this burning passion for changing the industry and making it fairer. I mean, if you think some of the stats, some research that we commissioned, just over 70% of people feel like they're being ripped off by their lender today.
Yeah.
And when you start to think about that, could that be 5% wrong, 10% wrong? Sure, don't know. That's what stats are about. But 70% of people think they're being ripped off. There's something wrong with the system.
Yeah. Mate, I feel like I'm getting ripped off. I'm one of the 70. I don't know too many people actually have a healthy relationship with their bank. I think it's more of a reluctant relationship. And this goes back to a mortgage, right? So if you're going to have a mortgage, you may as well have it with someone who you think actually gets you. And I had to pick through some of that research that you've put together. People are annoyed with the slow process and hidden fees, 55%, too much paperwork, 48%. So, it's interesting numbers. Who was the first to say between yourself and Chris, you know what, stuff it. Let's throw in these big salaries and the security and safety of a bank. And no doubt you've got families and stuff, and let's go out on our own and make our own way.
It was actually both at the same time. And the intersection was Chris came at it from a personal lens. So he's a property investor, and he looked at it and asked himself the question, hey, look, both myself and my wife are employed. We work for big companies. We earn good salaries. We're property investors, and we've got our own mortgage. Why is it that I can't get a better rate than anyone else? That doesn't make any sense. And why is the process so broken? There has to be a better way to do this. So he came at it from, this is my experience. There should be something there. And I came at it from, the system just seems unfair. And so I said, well, the system's unfair. And I'm a political philosopher by background. And so one of the things that you do know as a sort of a political philosopher and economist is returns will always regress to the mean over time. Everyone sort of knows that. Investors should know that. And where excess rent is being taken off people, or returns are being taken off people, and they're not adding value to the process, eventually that excess spread and value will be returned to the system. That's how all disruption works over long periods of time. And so if you look at the banking system in Australia, that was my point, which is globally, they're the most profitable banking sector in the world. That's been true for the last decade. So they're getting overall an ROE of somewhere in the 12 to 13%, where banks globally, retail banks, were getting 7 to 8%. So you looked at that and go, they're getting twice the return on equity of comparable banks in the rest of the world. Are they delivering twice the customer experience? And everyone listening to this podcast knows, well, they're not delivering twice the customer experience. How is it that they're getting twice the return on their invested dollars as shareholders? And the answer is because of the market structure. They're an oligopoly. They haven't had to innovate. They're still getting the flow. And I looked at that and said, it's time to change the system.
I think you're channeling some really Scandinavian philosophies there, which is sort of quasi-socialist around fairness and making sure everyone gets a fair crack at stuff. It's not a bad place to actually come from in terms of creating a business where, much like we're trying to do here at Smart Property Investment, better outcomes for Australian investors.
Look, it's a particularly Australian thing too. I know my voice isn't particularly Australian, but it's a particularly Australasian thing. Like most people, in fact, almost everyone believes that everyone should get a fair crack. Everyone should have a fair go. And, look, when the large majority of people think that the market benefits the lender and not the borrower, something has to change. That's the core ethos of our business. Something has to change.
So let's get nerdy for a second. Yourself and Chris, tech backgrounds, or you've had to bring in the sort of tech talent. What's the stack you've built the platform on? Can you give us some insights into all of that?
Yeah, look, I've run lots of big tech programs inside of the financial institutions. So I know just about enough to be dangerous and think that I know what's going on, which is why we did bring in a very capable CTO and a very, very good development team. So we've got, I'll just harken back to a point I made before, Phil. So if you think about our business, so we've got globally leading innovation where it intersects with the customer, the experience and the technology stack and what they want. And we've got bank quality governance and compliance where it intersects with funding, treasury, and compliance. And it's the split in the business. Yep. So our technology stack, we sit on a Salesforce backbone. It's AWS, so it's in the cloud. And it's a microservices stack where we pull data through an API layer. So to get an AVM, we get to core logic and we do the bank scrape. We use different parties to get the data in to make that credit assessment. The customer journey and all of the algorithms that are sitting on that tech stack are all proprietary. So it's a proprietary platform we've built. It sits in the cloud and it sits on Salesforce.
Okay. Interesting. Well, for our tech people, they're probably going, oh, wow, that sounds really super interesting. I think everyone's got to be a tech business these days. And all your development guys, obviously not in the office at the moment. They all Australian based. You offshore any of that stuff?
No, they're all Australian based. And look, it's interesting. One of the things that I got fundamentally wrong when we set this business up and raised our Series A, in April last year was, and this is remember at the start of COVID, I made the assumption that human resource was going to get cheaper. Like, guys, we're going to go into build, it's COVID, the world's in a pandemic, the rates that we're going to pay are going to drop because everyone's going to be worried about their job. It's interesting with the benefit of hindsight how you can be 100% wrong. So,
mate, developer salaries are rocketing at the moment. I reckon 30-40% increase from back to that point in April. And so we sort of invest in tech as well. They're the hottest thing in town at the moment.
Yeah, look, structural full employment in that sector has been true for at least the last 6 months. And look, that's because the largest pool of talent in the world that had that service, being India, has been really hard hit by COVID, right? And so when you take what is maybe 5 to 6 million people who were the back end of development, business intelligence and data science, and you take them out of the market, that goes onshore again. And so the onshore people are sitting there well overworked, and you're giving your kids advice now, you'd be pointing them in that direction, wouldn't you?
Oh, yeah, you think so. It's you're definitely going to have a job into the future. And give us a sense for sort of the culture of the business. How are you sort of building it out? Is it sort of relaxed tech, prop tech type sort of flavor? Everyone black shirts and the whole ping pong table and the whole kit and caboodle. You come here, we've pretty much got similar.
Yeah, that's a great question. Look, we're a team of 65 people now. And we've got that real split in our business, Bill, because we work in a highly regulated industry, being lending, and we've got pretty big wholesale lines that come from highly regulated counterparties. We've got a third to a half of the business that they operate like they should. There's no ping pong, there's not that many black t-shirts. It's a very, very serious enterprise. And then you've got the tech side of the business and the marketing side of the business. And, we pride ourselves on pushing the envelope. We pride ourselves on doing things differently, which is, how we've managed to build this business. And as a leader, you've got to wear these two hats all the time, don't you? You have to be mindful that, as I said, highly regulated industry on one side, innovative on the other. So you're constantly changing hats and changing gears.
Yeah, no, absolutely. It sounds very familiar. And conscious of time, Andrew, I'll close with this question. And for property investors, and so sort of a wide-reaching discussion. And I wanted property investors to actually understand the inherent macro structural shifts to the way in which mortgages are going to be available moving forward. And hopefully that will change and shape their paradigm and perceptions towards how they go about skewing finance into the future. And I think you're silly not to be considerate of all the options available at the moment and into the future for you as a property investor. And a lot of it's going to be around rate, but not everything's about rate. It's about the product itself. It's about the business that you're doing your home lending with. And this will shape it and grow and evolve over time. We're very fortunate in Australia. We've got some very smart and talented people who are paving the way. And, to numbers out of the US, 30% of all loans now are digital. Rocket loans out in the US really has made that sector what it is today. So it will happen in Australia over time. $2 trillion, $360 billion a year gets sort of churned through, or whether that's the right word or not. So that's a big number for digital mortgages moving forward. So let's just hypothetical, we get together, Andrew, in 2 years' time. What are we going to be talking about, mate, when it comes to how property investors can secure finance through you?
I think what we'll be talking about in 2 years' time, if we're talking about our business, we'll be talking about the legacy of innovation that you'll see over the next 2 years. So we're a refinance only shop now. It's our first product to market. We'll have new purchase out, split, cross and multi-loans shortly, along with new purchase in Q4 of this year. We'll be talking about how that's gone, and we've got some pretty interesting things to announce later in the year on how we're thinking about new purchase and products and how we can innovate again in the marketplace. So we'll be talking about how new products, even though, for new purchase, for example, we can have a different spin on how you think about going to market with products to make it easier for the customer. We'll be talking about that. We'll be talking about how our technology is now being used by other players in the marketplace to improve the customer experience inside of their shops. So we'll be having that conversation. So that B2B conversation as well as the B2C conversation. And then for this, I think what we'll be talking about is how when you've simplified your product down the way that we have, but you've got what is ostensibly a full bank replacement product suite, we'll be talking about how your customers and listeners have found the experience with us brilliant, because they get all of the payments, all of the reporting, they get all of the functionality, they get a better rate. It's all in one place. And so when they get to their end of year processes, there's full transparency. There's no hassle, as we spoke about before, in managing their affairs. But we'll be talking about how much better it is and how much simpler it is for investors to go with Nano.
Excellent. Website, Andrew, if people want more info.
Yep, the website's nano.com.au. It's pretty straightforward, and all of the information's on there. Look, we would love to have you guys as customers, the people that are listening to this podcast, and we're committed to making the best experience possible come live for you.
And a lot of our investor clients have, and I've definitely put myself into this pool. I've got pretty complicated structures as a property investor. Is that going to be the future as well? Am I going to be able to sort of go, hey, I've got umpteen number of properties and all these trusts. You want to give me some money? Here's all the information. Is that the future? Because I hope it is, because I find home lending an onerous process.
Yeah, it is. And look, as a disruptor, what you do is you start at a part of the market which is simple that you can prove the algorithm and disrupt. And then you move up the complexity curve. And as I said, we're going to have multiple loan or multi-cross and split loans coming up shortly, new purchase coming up. And then, where people do have complicated affairs, we do have an underwriting team that can help out to work that through.
Well, when you're ready to have a crack at my stuff, I'm more than happy to pass it over. It
I'm a little terrified.
Might blow your system up, mate, but that is the future. Andrew, I really enjoyed the chat today, mate. As you can see, I'm a passionate prop tech person, and I right behind it as you are to shape and create better outcomes for Australian property investors and homeowners. So keep up the good work, mate.
Well, thank you for having me. I really appreciate it.
No worries. That's CEO of Nano Home Loans, Andrew Walker. A lot more chats around emerging technology and how it can help us as property investors make more informed decisions. And that's what the Smart Property Investment Show is all about. I hope you enjoyed it. Remember, there's plenty of other podcasts you can go and tune in. We pretty much covered off most things in property, but we keep at it and trying to find new angles on most things. smartpropertyinvestment.com.au, social media. You can find us at Smart Property HQ. You can probably go and follow Nano as well. Just search Nano on any of the social platforms. You want to check those guys out. Thanks again for tuning in. Remember, one favor for me, please. Please keep those reviews coming wherever you're listening to this podcast. I'm sure Andrew's going to do one as soon as he's off the phone, whether there's Apple or wherever you choose to listen to it. It's just not myself here behind the mic. I get to do the best bit of this job, and that's the talking, but got a really talented team of producers and podcast professionals here who make me sound good. I'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.